Welcome to the Single Source podcast, featuring fund managers at the forefront of private markets.
I'm joined today by Jeff Haas, Portfolio Manager and President of SR Alternative Credit. Jeff, let's talk about your flagship OHPC fund, the hybrid evergreen structure. What's the strategy behind the fund?
SR Alternative Credit is a private credit manager that focuses on asset-based lending. The firm has been around in one way, shape, or form since 2009. And what we do is we focus on senior secured asset-based lending transactions that are in the $10 to $50 million space, with the goal of trying to create a net return for our investors of somewhere between 10 and 13%. That tends to be a smaller type of transaction. And what that allows us to do is really work very closely with the borrowers and structure protections into transactions that maybe some of these bigger deals don't have in the form of covenants, triggers, things of that effect.
You had told me all private credit is not equal. If you turn on CNBC, Bloomberg, any financial news program, how can you ease investors' concerns? Because it seems like there's a lot of concern in the private credit space in general.
Heather, I think that I've spent a lot of time, especially the last couple of months, talking to some of our existing investors and new prospects. You're right. I do look at the private credit space, and I do say it is not all created equal. Is it a direct lending cash flow approach, or is it an asset-based lending approach? The other thing is, I guess, the way you come out that from a protection point of view is the cash flow side of things tends to be a little bit more sensitive to the economic cycles. Asset-based lending, while prices do respond to the economic cycle, you do have a certain level of protection because you're lending at a discount to an asset value. Recovery rates in that space tend to be a little bit greater. I think anyone in the private credit space is taking advantage of the inefficiencies that have obviously been created by the traditional banks leaving the space. We try to take advantage of inefficiencies by looking at transactions, that we think are kind of in the smaller scale, the $10 to $50 million transactions, right? So that's where we're trying to get to, getting a net back to my investors after our fees of somewhere between 10 and 13. And that's really an unlevered return.
We talked about the current environment. You addressed why it's attractive for your lending strategy, smaller scale investments, 10 to 50 million in transactions. What types of borrowers and deal structures does SR Alternative Credit primarily target?
When you take a step back and look at our background historically, we look at these harder asset transactions and financial asset transactions, but we actually just did an analysis not too long ago where if you look at the 90 or so deals that we've done, about 65% of them have been in specialty finance. We see a tremendous opportunity in that space because post-financial crisis, the explosion of specialty finance companies themselves has been as significant as the opportunity in private credit.
So how do you underwrite these deals and manage the downside risk to protect investor capital? LPs on Apex Invest are always concerned about managing downside risks.
I would say what SR Alternative Credit does, the way that I really describe our approach is it's a full service lending platform. So the underwriting is really kind of a full service banking approach to a transaction. From a protection point of view, we need to make sure first and foremost that we have good collateral coverage, right? So from a protection point of view, it's all going to depend upon what asset are we lending against, what's the underlying liquidity of that asset, what's the visibility of pricing for that asset, and what's the appropriate discount for that asset. To make sure that we have enough cushion in transactions, because lending, as everyone knows, is, if you think you're not going to have defaults, you're fooling yourself. We like to work with some of these smaller borrowers because most of the time, the principals that are involved with those companies, it's their capital they've been using to generate and grow those businesses. What we ask of them is they need to have capital at risk. They need to have skin in the game, right?
Okay, so put your financial advisor hat on for a moment instead of the portfolio manager. Where does SR Alternative Credit funds, where do they fit within a broader income or diversified credit allocation for investors?
What folks have been attracted to for us is the ability for us to generate income, right? it's great to generate an attractive yield. But if you can't distribute that yield, what good is it to the investor? So everything we focus on is cash flow. So for the advisors looking for this, the opportunity is asset-based lending. It's a little bit more defensive if you have any private credit exposure, and it has a yield income distribution attractiveness to it.
Thanks for listening. For more, visit apexinvest.io.